you know the academic definition of informed investor? These guys have perfected their game against retail investors like you. In this video, we'll explain how they stay ahead of the market, why the fundamental trend behind this institutional approach affects 5,000 stocks, how to protect and enhance your trading strategy by adding just one simple step to your routine. But why trust us? Great question. For the last 3 years, Visual Sectors had modeled new swing trading strategies based on empirical studies. This isn't your grandfather's financial advice. These strategies are the real deal. Our team of experienced quants, analysts, and data scientists has developed and backtested over 300 indicators on 12 years of market data, and we've officially cracked the code. Sort of. While no one can truly crack the stock market, our models do offer a way for traders to increase their odds, and the data proves it. In just 3 years, our models generated over 32,000 trade signals across hundreds of stocks, with an average win rate of nearly 80% and average monthly alpha of 2.9%. In fact, our sort of code cracking is so official, our models have been validated by Professor Ali Dadpei of Texas. Our models have helped users like Luke, Max, exceed win rates of 80% and earning seasons profits of 15%. Of course, given the sheer speed of modern markets, any signal is most effective for traders who dive in first, even with models as advanced as ours. So, we won't keep you waiting. It's time to dive into the ways informed traders stay ahead of the market and learn the one simple trick to beat the market swings, funneling your money into their pocket. Let's start with the story. By 2021, the Future Visual Sectors team had been trading for years. Some of us used fundamental ratios, others played with technical charts. Then, meme stocks hit, and demonstrably bad companies saw their valuations soar. Our founders knew they had to do something about it. They dove deep to understand what was happening, how to protect their strategies, and even how to benefit from the chaos. When the media started spouting about gamma squeezes, options entered the equation. Gamma squeezes occur when extremely high demand for call options forces market makers to buy actual stocks to stay risk neutral. Usually, this isn't an issue, but in some cases, excessive demand leads to a perfect storm, like it did with AMC and GME. Sudden demand squeezed the supply of these poorly performing, heavily shorted companies, forcing market makers to buy at higher prices. This ignited a chain reaction, where call prices spiked after companies piled in, requiring them to readjust their holdings. At that point, it was obvious how stock moves could influence options. But was the reverse also true? We had to find out, so we started digging. And here's what we found. The Financial and Investment Planning Research Network, a massive online database of empirical research studies, 21,000 empirical research papers written by 27,000 experts covering all areas of trading and investing. It's an open resource with massive value, and yet ignored by traders watching their life savings go down the drain. People like you who can't afford to lose again, but can't afford not to trade. One research paper stood out. It quoted articles written way back in the 70s about so-called informed investors. These actors operate with more intel in markets that disseminate information asymmetrically. We're not talking about inside traders. We're talking about the ability to access and process more data, and therefore gain the advantage over the little guys trying to trade their way to better lives.
It doesn't feel right. It doesn't feel fair. Why you? Why are you sitting in that chair and not somebody else?
In the 40 years since, studies have confirmed that these traders prefer the options market. So far, doesn't seem like it affects you, does it? Here's the catch. Sometimes the options market doesn't have enough liquidity. Enter bids and asks. Consider an out-of-the-money options contract priced at 20 cents. You might see bids as low as 15 cents and high as 25 cents. When these traders execute at the ask price, the trader is immediately 5 cents down. That's a negative 20% return just to enter the trade. In these conditions, informed investors jump back into the stock market, which can spark unexpected price moves. That's just one way options activities can interfere with the stock market. Our chief analyst, Brian Tancock, is here to explain another reason stock traders should watch options data.
Research shows that options markets can predict future stock price movements. One study from 2019 saw that stock pricing pressure and informational asymmetry both contributed to the options market's ability to predict future stock price movements. Another study from 2020 showed that informed options trading can actually predict jumps in future price movements. And by arbitraging those jumps, you can add up to 153 basis points in monthly alpha to your trading results. And a second study from 2020 showed empirical evidence of informed options trading ahead of corporate announcements. These findings corroborate the evidence from a 2011 study that suggested that the difference between actual stock price movements and option implied stock price movements can predict future returns up to 3 weeks in advance.
As you can see, the connection is clear, and the bigger trend is inevitable. A growing derivatives market means that more stocks now have options than ever before. Today, over 5,000 of the most popular stocks are now optionable, and trading any one of them exposes you to the hidden trends built and acted on by informed investors. That's right, you're being manipulated and spied on by the big guys, even if you've never touched an option. It's time to stop being taken advantage of by informed investors and start taking advantage of Wall Street itself. You might be thinking, we're about to push you into complex equations or a laundry list of vocabulary words, or assign you hours of homework just to figure out what this data flow means for your open positions. That couldn't be further from the truth. We did the heavy lifting for you, scouring 25 of the most relevant research papers on the FRN. Here are the 3 most important concepts to understand. The upside: you will track informed investors, not be tracked by them. Plus, you'll boost your profits and start making money your first week with no additional workload. In fact, you'll spend less time and energy trying to figure out what's happening than ever before. Let's get to it. Metric number 1, volume. Similar to stock volume, options volume can indicate investors' sentiment, but it's combining the two that works miracles. In 2013, Stanford professors Travis Johnson and Eric So studied the correlation between stocks and options. As we already know, informed investors lean toward options for their leverage, but when spreads are bad, they swing back to stocks instead. So, by looking at spreads, one can predict when informed investors prefer stock trades when spreads are large versus options trades when spreads are small. See where this is going? Higher options volume means smaller spreads. Some investors may lean toward options instead of engaging with the stock market directly. In the reverse, lower options volume forces these traders into stocks. Bingo. Tracking the options to stock volume ratio is a great way to beat the market for trades lasting under a month. In fact, long-short strategies, where you go long on firms with lower option stock ratios and short on firms with higher option stock ratios, can result in risk-adjusted returns of almost 1.5% per month, or over 19% per year. We'll talk about how you should do that later. First, we have to talk about moneyness. Let's try to break this down visually. Here is the stock price axis. In an options contract, expected stock prices are called strikes. At any given moment, you have strikes above, below, and at the current price. Bullish traders want the stock price to be higher than the current value. Since it's not there yet, you buy a call option with a strike price that's higher than the current price. If you bet correctly, the call contract gets more expensive, but if you're wrong, the contract is worthless. These types of contracts are out of the money. You don't get anything when they expire. Let's look back at our axis. If you go long and buy a call contract, the area above the current price is out of the money. All strikes below the current price are in the money. It's the opposite for bearish bets. Out of the money put options have strikes below the current price, while in the money puts have values above the current price. This ratio is called moneyness, where at the money contracts are at 100% moneyness. Now, we're ready for some magic. 2 different studies have created alpha-generating strategies around this concept. The first compares the change in open interest of calls and puts above the current strike. They call their metric market-sidedness. Basically, this metric compares the risky out-of-the-money bets that bulls and bears make. Tracking the difference gives you a mathematically proven expectation of 2% alpha in just 4 weeks. Again, we'll go over the details on how to trade, where to get the data for free, and a simple 3-step plan to enhance these strategies in just a few minutes. The second approach is basically another version of this comparison, except it promises up to 33% alpha in volatile stocks. This time, you weigh all of the changes in open interest by strike. So, if you have 100 contracts at strike 100 and 1,000 contracts at strike 200, the average moneyness, or AV money, is 190. If the current price is $150, that's bullish. If it's at $200, that's bearish. Simple, isn't it? Metric number 3, dispersion. The next concept builds on the previous two. We know how volume can be a good indicator, and moneyness can show risk appetite. Now, we need to know how to measure how everyone in the market is creating upward pressure. Please welcome dispersion. Now, there's a clear relationship between stock returns and situations where most traders trade very close strikes. If everyone jumps into a specific area, whether that's puts or calls, the stock is more likely to be attracted to this concentrated level. Once you see a clear dispersion of bets across the board, you can clearly ignore the unusual activity in one of the strikes. Even if that trader has asymmetrical information, it's unlikely to result in a massive underlying asset move. The reason is simple. Markets can't be moved by a single person's beliefs or desires, even if that person is Elon Musk. And at this point, you're probably asking, what's in it for me? Yeah, it's cool you nerds know all this stuff and read a bunch of research papers, but I want to make money. How can I trade right now? And you're absolutely right. You need specifics. How long should I hold? What expirations do I look at? Where's all of that free data? How quickly can I start? We get it. That's why we've created a detailed description of these and many others. Strategies in Visual Sector's free strategies hub. Our hub offers clear step-by-step guides and strategies based on stock option correlation research, plus free SPY indicators. It's incredibly easy to use, and every strategy is data-backed and sourced, so you can start generating solid win rates and alpha with ease.
So pick it up, put it in your pocket, and walk out of here. Or I will.
Plus, we offer visual aids and video explainers, so you can literally see the difference good data makes to your trading strategy. So click the link in the description and get free instant access to a wealth of information sourced from the greatest financial minds of our generation, and broken down into bite-sized pieces for traders of every level.